Hello guys, welcome back to my channel. This is Soji and you are welcome to Soji Forex. In today's video, we want to look at liquidity and mitigation theory. From our previous video on liquidity, we said that liquidity simply means money. It is that area of the market where money lies. And we say, what is money? We say money are stop loss that are lying in the market. So the market always moves in the direction of liquidity. So today we want to look at liquidity and its theory. We want to look at basic liquidity and its theory. So that is what we'll be looking at in our brief example today. We'll be looking at liquidity theory. Liquidity theory. Okay. Remember, we said liquidity is money. Liquidity is nothing but money. So, what is the first thing you do when you open your chart? The first thing you need to do is for you to identify the direction of the market, which means you need to identify if and only if the market is either bullish, bearish, or a ranging market. What am I trying to say? You need to establish if you are in a downtrend, an uptrend, or a ranging market. So looking at this chart, let's identify our directional bias to know where we are. So looking at this, first we see that the market is making a lower high. Okay, lower low, lower high, lower low, lower high, lower low. Okay, and somewhere around this zone we have a change of character. We have a change of character here, which is the CH. Okay, have our lower low, lower high, lower high, high, lower high, we have lower low. So somewhere around this point we have a change of character, somewhere around here, and from that point we see that the market begins to behave in a different manner. Now from what we are seeing, we see that the market begins to make some move. Begin to have low, high, higher low, higher high. And then from there, we now realize that this place is moving more like a double bottom, and that is a liquidity has been built up. Remember, we have been in a downtrend, then we begin to have a change of character, we begin to have a low, a high, we begin to have higher low, higher high, higher low, higher high. But if you look at this zone, it begins to look like a double bottom, which is an area of liquidity. And when we talk about liquidity, we are talking about money. So which means that there is money lying in this zone. Okay, and from here is where the market change character from. So what happened? You can see the impulsive, how the market move with force. Okay, this is institutional movement. It move, take away the liquidity, the stop loss of the people around this region, took them out, and then came into this zone. Right? It came into this zone, it moved down into this zone, and then moved to the upside. So look at what happened. It takes away this liquidity here. Right? It took away okay, this liquidity here was taken, right? Also, this liquidity here as well was taken. So I'm referring to this. It took this low, took this move. Money is here, money is here, and then it break all the way down, took away this liquidity, and then take away this liquidity. Okay, so this is the concept. And after taking away that liquidity, you will see what happened next. The market move from here now. Look at here too, we are having a double top, so it means there is a liquidity that is lying here. Liquidity was lying here, it has been taken. Liquidity is lying here, it has been taken. How? Because the market moves below those levels. And then it went to the upside, clearing away this liquidity in this top. How? If you are trading support and resistance, here could have been your area of resistance, right? And then when price reaches this level, look at what happened. There is a bearish candle that came down. You could have said, oh, this is a sell confirmation entry. You would have entered your trade, put your stop loss here. It went up, clear your stop loss, clear your money here. That is liquidity sweep. Having taken all this liquidity, now there is still a trade that was initiated from this down part. There is a trade that was initiated here that sweep away this liquidity. Okay, that sweep away this liquidity. A trade, a buy trade was initiated here, and that was the trade that took away this money in this your double top, right? So this trade, this entry that was initiated here is still here. So when this liquidity has been swept, price will now come back inside this other block. Now if you don't know what this other block, we'll refer you back to our previous video. So price will come back into this other block in order to mitigate, because there is a sell trade that was initiated here that took away this liquidity here, took away this liquidity here. Okay, so this sell took away these two liquidity. Another trade was initiated that went up and took away this liquidity of this double top, which moved all the way here. So knowing that liquidity was taken here, the institutions are in a drawdown in this region. So this institutional candle, which is the last candle that went up to take this liquidity, after taking this one, is still in a drawdown. So market will come back to mitigate this other block, and this is exactly what happens here. It came back inside this other block, mitigate the other block, and then begins to go up, or it mitigates the institutional candle. So it is the return of this market back into that institutional candle that took away this liquidity of this zone and this zone that we call mitigation. Please, for more understanding, it is advisable that you watch our videos on liquidity, and also there is equally a video on order block. Okay, so now if you look at this, remember already from this zone it has been established that we are already in an uptrend. Okay, because from here you see that this high was taken, so we are already in a higher high, lower low. See this? Now this is a valid higher low. Why? Because the body of the candle, the body of that candle did not close below the previous low. We don't consider the wick when we are talking about the structure. You don't consider the wick. What you consider is the body of the candle. So if we use the line chart, good, you'll see that this body did not close below it. Good. So you see our horizontal line, and then see where the low is. Alright, so it did not close below this previous low. So you see now, this took away this liquidity, from this low. So here become an institutional candle. So they move all the way up, sweep this double high, took away those liquidity, return back to mitigate this other block, and then the market move to the upside. Please, you can refer to our previous video on liquidity, but the sole aim of this video is to show you how mitigation occur in the market. Okay, then after that, you see that the market move simultaneously to make a high and then a low. It's another higher high, higher low, higher high, higher low. So how do you continue in this trade? Now, if you have missed this entry, this is another entry. How do you make your entries around this region? It has formed a higher high. All you need to do is to get your Fibonacci tool, Fibonacci retracement, and then you fib from wick. If you are doing body to body of the candle, fine. If you are doing wick to wick, fine. Good. So now you see the level. So it moves from this point all the way to this point. So we confirm that this is a retracement. Just a moment. Let me add to the level. Just a moment. Okay, so you will fib from here to here. That is, you are using your Fibonacci tool to do what? To consider from the previous low to the recent high. Recent low to the recent high. You will draw your Fibonacci level. Okay, then what do? You will know that the market has begun to retrace. When the market returns and break below 23 level of the Fibonacci, which you are seeing here, you can see 23 there. When it breaks below 23, that is a sign of retracement. That is the first way to confirm you are in a retracement. Now, having established that, you will consider your premium and discount zone. You will only begin to look for where to make entry only and only if price return to at least 50%, which is where this price return to 50% of your Fibonacci. Once price return to 50% of your Fibonacci level, then you begin to look for smart money play. And what could be a smart money play? Looking at this trade, we will see that we are having a fair value gap. Look at here. In this region, we have a fair value gap. This shaded region. Now, what is a fair value gap? I think I've made a video on a fair value gap. It is also known as imbalance, because in the market, each of the candle is supposed to overlap each other. Look at this candle. Before this big candle you are seeing, this green bullish candle, this one stopped here, this one formed up, this one came down and stopped here. So, and ideally, this bearish candle is supposed to come all the way down to where this previous candle stopped. Supposed to cover it. Okay, there is supposed to be an overlapping of candles. You see these candles, you see how they overlap each other. That is the normal way a market is expected to move. So there is a gap here, and this gap is called imbalance or a fair value gap. So this market retraces, and once it has reached 50% level of your Fibonacci, you begin to look for smart money play. This smart money play, it can be an order block, it can be a smart money cube, it can be an imbalance. Then in this zone, what do we have? We have an imbalance here. Okay, and then upon this, you notice that price begin to reject. So if you go to your 15-minute time frame and you see this shaded portion, you will notice that there is a change of character or a break of structure on the lower time frame, and then the market moves to the upside. So then you make your entry based on the lower time frame break of structure or change of character. Right? Now if you miss this entry, we now have a new higher high, higher low, and then this price move all the way from here to this point, create a new one, and then returns back. So what do? All you need to do is that you pick your Fibonacci again, and then you mark from the new low to this new high. You see it? You mark from your new low to this new high. Your new low, yeah. If you are doing week to week, you remain. If you are doing body to body, so same process, same everything. So what happened? You see that price move to this high, and then it begins to come down. Immediately it breaks through this level of 23. We know that there is already a reversal, and they will begin to look from the level of 50%. to now begin to consider what is there to make this to play out. Is there a smart money? Is there another block? Is there a fair value gap? Now looking at this, we are having an order block in this region. Anything that makes the market on your lower time frame either at 50 or at 61 to begin to range, form a break of structure on a lower time frame, here becomes another entry. So you keep on repeating the same thing until there is a change of structure. So you now see that we have a new low and we have a new high. So here now becomes our higher low, here becomes our new higher high. So all you need to do in this new place, you still put your Fibonacci level, simple, and then you watch what the market do. The market retrace back to 78.5%, which is inside your order block. And then from there, you see the play. Okay. From there, you see that it came, tap into this order block. If you go to the lower time frame, you either see a break of structure, a double bottom around this region on the lower time frame, and then a move to the upside. So it keeps repeating the same thing. It comes here now, it makes a new high and a new low. So simple. You now move your Fibonacci to the new high, and then you see that here price returned all the way to 61.8 level. Why? When you look at this point, you will see that there is a red. Remember, all this space we're having bullish candle green, bullish candle green, bullish candle green, bullish candle green. Then inside here we have a single bearish candle. Then after that, impulsive move. So this single bearish candle red in the midst of this series of bullish candle is what we refer to as the smart money cube, which means that there are some bearish order. There are some orders that are lying in that region to form that particular candle. And then you see what happened. Price went up, retraces back into that zone, place around, go to your lower time frame, you see a break of structure, you see a double bottom, and then it moves to the upside. So this is how the pattern is. This is how to trade the market chart. You establish your structure, you identify your area of liquidity, and then looking at this trade, you will see that despite this high, this low, here looks like a double bottom. Here there is also a liquidity here, which price this candle take away those liquidity to mitigate this other block, right? So this is pretty simple, very simple. Even later in the future, price is still supposed to come back into this other block that took away this liquidity in order to mitigate. So I don't intend this video to be long, right? I believe you are getting value from this video. Please do not forget to like, share, and subscribe to our channel. In the next video, I will be making a video on how to make a high probability trade entries. High probability trade entries in order to filter your entries and have a high probability trade. So see you in the subsequent video. Please do not forget to like, do not forget to share, subscribe to our channel, turn on your notification bell so that you'll be the first to get notified whenever we publish our next video. And we are building a community on a Telegram where we can share trade ideas, share signals, but our goal is whenever we hit 1,000 subscribers, then we'll kick off. So let's get the group flooded. There will be a link in the description to join the Telegram, and as well as share the links. Let us get 1,000 subscribers so we can begin with giving of trade ideas and signals on our Telegram group. So see you in the subsequent video. Thanks.